Hi everyone, this is Dr. Nitin Choda and welcome to my channel. I have great news for you. The Federal Reserve just announced zero interest rates through 2022. I'm going to talk about exactly what this means to you and why it's great news for you. I'm going to go over three things in this training video. The first is the history of the federal funds rate over the past 20 years, because it's important to understand that history before we understand what the actual current federal funds rate and the future of the federal funds rate means to you and your wallet. I'll talk about a breaking news announcement from the Federal Reserve, from the central bank, and what it means to you. And then I'll talk about exactly what moves you need to make to take full advantage of the low, in fact the zero federal funds rate over the next 2 years, potentially longer. With that being said, I'll go ahead and get started. If you're not an existing subscriber yet, please consider subscribing below. Please enable the notifications button so I can give you important updates like this. And please click the like button because it really helps out the YouTube algorithm. So before I get started with the federal funds rate, let me give you some basics about the economy. Obviously, as you know, the economy has slowed down significantly because of this pandemic. But what does the economy actually consist of? The economy consists of buyers and sellers. A buyer usually uses cash or credit to buy something from a seller. A seller usually sells either goods or services or financial instruments, something like stocks, bonds, or even real estate. So essentially a buyer uses cash or credit to buy something from a seller, and a seller sells goods, services, or financial instruments. When a buyer buys something from a seller, you have something called a transaction. Depending on the amount of money exchanged, you have a dollar value or the size of the transaction. The greater the number of transactions, the greater the size of the transactions, the bigger the economy. For example, if you go to McDonald's and you buy something off the dollar menu, it's a transaction, but it's a transaction worth a couple of bucks. But if you buy a nice bottle of wine, or if you buy an expensive dinner and you spend $100 or more than $100, that is also one transaction, but that's equivalent to almost 100 transactions from the dollar menu, because that the size of that transaction is significantly bigger. This is why credit is such a huge part of our economy, because when you have a buyer and seller, if you have a buyer who uses credit to buy something that they would not normally be able to buy, you have a bigger transaction. So credit is a very misunderstood term. I believe that when credit is used intelligently to help you make more money, for example, when you buy rental properties like I do, I borrow money at 3%, 4%, and my rental properties make 10%, 12% or more. When you use credit to enhance your standard of living without it getting out of control, in other words, you have the ability to pay off your debts, like a low interest mortgage, for example. That's an example of good debt that allows you to raise your standard of living. On the other hand, bad debt consists of situations where you buy things that you don't necessarily need, that you definitely can't afford, where you end up paying a high amount of interest and you get caught in the never-ending cycle of credit card bills and high interest payments. So you definitely want to stay away from bad debt. But credit in the form of good debt allows you to live a higher standard of life and allows the economy to grow, which essentially is what's helped the US economy to grow over the years and essentially drive the rest of the world economy. So just as you have a buyer and a seller, you have a lender and a borrower. Now, a lender usually consists of a bank that wants to lend money. And by the way, this is where the federal funds rate comes in, because the federal funds rate is the rate at which banks can lend money to each other, and it's dictated by the Federal Reserve. So going back to the lender and the borrower, the lender usually consists of a bank who wants to lend money, usually at a certain interest rate. Now, the bank is not going to lend money at the federal funds rate, because that's the rate at which they get money. They'll usually lend money at 2%, 3%, 4%. So they make that spread in between, and they make money on all the fees that they charge. That's how banks make money. So a bank essentially wants to now lend money and act as a lender, and then the consumer, who's the borrower, now borrows that money. And given the circumstances that we're in right now with the low federal funds rate, the borrower or the consumer is going to be able to borrow money at a very low interest rate to buy a house, to buy a car, to get a personal loan, to do whatever they need to do. This is what the government wants in order to be able to rejuvenate the economy, in order to get individuals to start spending again. That is what gets more transactions going, and that's what also contributes to the size of the transactions. So you have a lender and you have a borrower. The lender usually wants to make interest on the money that it has, and the borrower usually wants to buy something that they can't afford without borrowing. So what happens to the borrower is that they borrow money and then they pay back the principal and the interest to the lender, and it's at that point that the credit or the debt gets eliminated and the transaction is considered settled. Now, this credit or this debt is not a bad thing because it allows both the lender as well as the borrower to get exactly what they want. It allows the lender to make more money by way of interest, and it allows the borrower to buy something that they would not normally be able to afford, like a house, like a car, or any other things that they would need to buy. A business owner, for example, would borrow money in order to be able to grow their business, in order to be able to expand, in order to be able to buy inventory, buy equipment, hire more employees, which in turn leads to more transactions. Because at the end of the day, when one person spends money, whether they got it through cash or whether they got it by borrowing, as long as one person spends money, another person is actually earning that money. And then when that person spends the money, a third person is earning the money. So $1 that you spend starts to make its way through the rest of the economy and starts to stimulate the rest of the economy. For example, when we go out there and when we start, let's say, going to a local diner on a weekend and having breakfast, which is something that I'm sure a lot of us want to do. I want to do that because there's a diner right down the street from where I live, and we love going to that diner, and I know what I get every Sunday. When you go out to that diner and when you buy breakfast, you're spending money, which now allows the individuals at the diner, which allows the employees at the diner to be able to earn a living. It then allows the diner to purchase food from its suppliers, who then in turn employ more individuals, and those individuals now go ahead and spend more money. Maybe they go and get a car, or maybe they go and buy the house that they were thinking of. So essentially the money starts to make its way through the economy, and that brings me to the federal funds rate. The federal funds rate is the rate at which banks lend money to each other. The fact that the Federal Reserve made a breaking news announcement to keep the federal funds rate at 0% or close to 0% through 2022 basically means that it's going to be cheap to borrow money. This is extremely significant because for those of us who make the right money moves over the next 2 years, I'm talking about saving money, I'm talking about paying off all your high interest debt, refinancing your debt, consolidating your debt, and essentially lowering your interest payments and getting out of debt. They are the ones who will be able to emerge from this economy and emerge financially stronger. So let's take a look at the history of the federal funds rate over the past 20 years. And this is data from the Economic Research Institute at the Federal Reserve Bank of St. Louis. Now you'll see in January of 2000, the federal funds rate was 5.45%. This is the rate at which one bank basically borrowed money from another bank, and this is what's dictated by the Federal Reserve, by the central bank. And so you can see that what happened in 2001 was 9/11 happened, the economy took a big hit, and that's when the Federal Reserve lowered the federal funds rate all the way down. It came down to 1.82% in December 2001, and then it continued going down, and in 2004, March of 2004, it was all the way down to 1%. As the economy started improving, the federal funds rate started to go back up, and you can see that it started to go back up from 2004. It kept going up from there, and then it started going up gradually over the years. In 2006, it started to reach 5.25%. 2007, it was at 5.25%. And then the subprime mortgage crisis happened in 2008, which is when the economy tanked again. In fact, the federal funds rate went all the way back down to 0.15% in January of 2009, and it stayed low for many years in an effort to rejuvenate the economy. And then in 2016, it started to go back up again because the economy was doing well. And in June 2019, it was at 2.38%. Now, if this hadn't happened, if this pandemic hadn't happened, it would have kept going up. But right now, in May 2020, as a direct result of everything that's happened as a result of the pandemic, it's gone back down again, and it's at 0.05%. And if you look at what history is showing us, what we're seeing here is that whenever the economy takes a big hit, the federal funds rate is dramatically reduced. And as the economy starts to recover, the federal funds rate is gradually raised again. Because when you lower the federal funds rate, you make it easier to borrow, you make it cheaper to borrow, and that's when more individuals are more likely to borrow, and banks will lend the money as long as they know that the borrower is credit worthy, and this in turn will lead to more spending, whether it's buying homes, buying cars, buying new TVs, buying new refrigerators, buying new phones. This is what leads to a rejuvenation of the economy, and this is what the Federal Reserve wants. This is what the government wants, to keep the economy humming along. Now, I predict that over the next couple of years, the federal funds rate will be close to zero because the Federal Reserve said so. But beyond that, I predict that the federal funds rate will gradually start to rise. In fact, if you take a look at this article on CNBC, you see the article says Fed sees interest rates staying near zero through 2022. And it says the Federal Reserve voted Wednesday to keep benchmark short-term rates near zero. In addition to the rates move, the Federal Reserve is going to prop up the economy by buying bonds, $80 billion a month in treasuries and $40 billion a month in mortgage-backed securities. In other words, the Federal Reserve is going to make sure the market is propped up, the market feels confident because it comes in with its unlimited wallet and simply says, I'm going to keep buying, there's nothing to worry about, there's a lot of money and there's a lot of liquidity flowing through the system, all of which is good because it prevents the market from panicking, it prevents home prices from falling, it prevents the stock market from crashing. So all of this allows asset prices to remain steady. In fact, here's what Federal Reserve Chairman Jerome Powell said. He said, we're not thinking about raising rates. We're not even thinking about raising rates. He said, what we're thinking about is providing support for the economy. We think this is going to take some time. Now, also keep in mind that very recently the National Bureau of Economic Research officially declared that a recession started in February. So there was a long expansion for many, many years, and that expansion has officially ended because the US economy is officially in a recession. So what did the Fed do? The Fed has decided to keep interest rates at or near zero up until 2022, and the Federal Reserve also said that they expect to maintain this target range until it is confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals. So what does all of this mean for you? Here's what this means. If you have an opportunity to save at this point in time, whether it's from your stimulus checks on employment income, or if you're lucky, knock on wood, if you still have a job and your income is still continuing to come in, you would be well advised to save as much money as you can and to pay off high interest debt. You should look at all the debt that you have and you should tally it up, and you should say, all right, I'm paying 3% on my mortgage, I'm paying 6% on such and such, I'm paying maybe 9%, 10%, 15% on my credit card loans. Pay off your high interest debts as quickly as possible, because it is going to be possible to borrow at low interest. You are going to see a lot of 0% APR, you're going to see 2%, 3% APR offers emerge, whether it's for buying cars, whether it's for credit cards. You are going to see those emerge. I know that there was a bit of a panic over the past couple of months, which is why some of these offers disappeared, but you will see the ability to borrow money at relatively low interest rates. You want to be able to do this if you can use it intelligently, to make more money, to enhance your standard of living, and more importantly, to pay off high interest debt. So my advice to all of you watching would be, number one, save as much as you can. Number two, if you can borrow intelligently at a low interest rate and then pay off high interest debt, and if you can borrow intelligently at a low interest rate and even make more money, what I do is I own rental properties. I'm able to get loans from between 3.5% to 4%, and I'm able to then make 12 to 13% on those rental properties. So I'm effectively able to leverage money to work for me, because at the end of the day, how do banks make money? They borrow at the federal funds rate, which is currently 0.05% at the time I'm recording this video training, and then they lend out that money to someone who needs a mortgage at whatever the rate is, 3%. They lend out that money to an investor like me for a rental property at 3.5%, 4%. So that's how they make that money in the spread. The question is, can you borrow at a low interest rate and then find ways to make more interest or to make more from that money? Now, I'm not talking about day trading in the stock market. Let's be clear. I'm talking about rental properties. I'm talking about starting a business and making more money and compounding that money. So you want to be intelligent and strategic. You don't want to take shortcuts. You don't want to try and win the lottery or get lucky, because that's not how wealth is made. Wealth is made by gradually increasing your assets over a period of time. And I think this is a golden opportunity to be able to refinance debt and to be able to borrow at a low interest rate and then make money at a higher interest rate. I hope you learned something new from this video. I appreciate you all watching. If you learned anything new, you can do me a favor and you can click the like button. It really helps out the YouTube algorithm. That's all I ask for, because it takes a lot of effort to create these videos, and I'm sure you've seen my body of work in the playlists that are on my channel and in all the videos and in all the content I'm putting out. I release videos at 2 p.m. East Coast time most days of the week, so I would appreciate you checking out those videos and showing up at 2 p.m. to comment on the videos, because I do participate in the comments in the first half an hour to 1 hour that the video is released, and I'd love to engage with you. Thank you so much for watching. Please click subscribe, please enable notifications, and please click the like button because it does help out the YouTube algorithm. I appreciate you. I'll see you in the next training video.